Welcome, 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 everyone. Thank you very much for coming today. We have our wonderful Kathy Scalzo, who will talk to us about infinite, I call it infinity banking. Is that right? I'm calling it the wrong thing.
Well,
Infinite
that's what,
banking. I call it infinity because for me, infinity is forever. And I kind of look at the long of everything. And I was corrected today bringing that up because it's called infinite, which I don't see what the difference is between infinite and infinity. So take it away,
they're
Kathy.
really,
Thank you.
they're really, it's just a marketing term, really. Infinite banking is the term that was coined by R. Nelson Nash, who wrote the book Becoming Your Own Banker. And since then, other people have put their own twist on it. Some people call it infinity banking, some people call it bank on yourself. Just different terms for the same concept. So I wanted to just follow up on what Harlan was talking about a couple weeks ago with the reverse mortgages, because it's a very interesting concept to go along with infinite banking, infinity banking, whatever you want to call it. I don't sell reverse mortgages myself, but I just think it's a really fabulous concept because I used to think that it was just a last resort, for people seniors that just didn't have any money left. But now I realize that there's so many more advantages to it, especially for investors. Like if you want to be an investor and you have all that money just stuck in the walls of your house, it's not doing you any good at all. So you can actually access that money that's in the walls of your house through a reverse mortgage if you're 62 or older. So one of the biggest objections to reverse mortgage is that the kids are going to get screwed and they're not going to have any money, which that's no longer true. I mean, they've made a lot of changes. It's now called home equity conversion mortgage. But if that's the big objection, you don't want your kids to be screwed, then there's the option of having a life insurance policy to make sure your kids get that money. So I just wanted to show you an example of a life insurance policy. If suddenly, like say you have a $2,000 a month mortgage and you got a reverse mortgage, so now you no longer have to make that payment. You can get money out of the house if you wanted to, or you can just not make the payment, or you can have them pay you. But I'm going to say, like, just no longer making that $2,000 a month payment. You can then start a life insurance policy instead. So do I have share screen ability?
You should, yes.
Okay. So I just want to show you an example. If you're 62 years old, this is showing an example. Like if you wanted to take advantage of one of the amazing opportunities that Peggy and her team have for an investment, say you have $50,000 to invest with them. If you just added the one additional step of creating your own private bank with a life insurance policy, you can deposit that $50,000 into the policy first and plus pay the $2,000 a month into the policy instead of a mortgage. Then you can turn right around and leverage the policy, take a loan out for that $50,000 that you want to invest with Peggy and her team or whatever else. So this is just an example of a 62-year-old paying, depositing $50,000 upfront, $24,000 a year annual premium, which is $2,000 a month. So the cash value that you would have ability to access in the first year, actually within the first 30 days of issuing the policy, is $63,000. So, and then you also have the nice little cherry on top of this death benefit. It starts out at $783,000. So that's likely more than your house is worth if you're worried about not leaving anything to the kids. So you can borrow out that $50,000. You are going to pay the insurance company interest, but they're paying you interest on this full amount, even though you're borrowing against it. So it starts out as kind of a wash, but with the power of compounding interest, you're going to be earning more interest than you're ever paying just within the policy. And then that's not even counting what you're earning on your investment that you're making with Peggy or whatever else. So this is showing basically, so at year 4 here, you deposit $24,000 into your system and you have more than $24,000 increase available to borrow out. So, and then you still have this whole death benefit. So I think that's a pretty good deal, right? So I'm going to show a different example of not.
Can I interrupt you with a question?
Sure.
So so you're borrowing the 50,000 plus maybe you took out the 24 also,
Mm-hmm.
and you didn't pay it back yet. And you pass away, and now you have this value of 863. They're going to deduct what you borrowed, correct?
Exactly. Whatever amount you borrow is deducted from the death benefit. So if you borrowed 50,000, passed away, then the death benefit would, be 733,000 instead of 783.
Thank
And
you.
then you can choose never to pay this back if you don't want to, because it's just going to be deducted from your death benefit at the end of the day. But ideally, you play honest banker with yourself, just like you would any other loan, pay yourself back. And basically, I mean, you're borrowing from the insurance company, so you're paying the insurance company back, but it's making your cash value increase again. So then you have the money to borrow again. So you pay it back, and then you borrow again for another investment, and you just keep repeating the cycle over and over again, increasing your cash flow more and more and more. So I just want to show you an example of not putting the 50,000 up front. Do you see the new illustration now?
No,
Just
still shows it.
let me stop and then reshare.
Because you look nice and purple.
Okay. Thank you. How about now?
Yes, shows two.
Okay, so you don't have to have a lump sum up front to start a policy. You can just start with the $2,000 a month. It'll take longer to build up money to invest, but don't get discouraged by not having a big lump sum. You put in the $2,000 a month or all at once, and then a lot of Peggy's investments, it's only a $10,000 minimum investment, so then you can borrow out $10,000 and invest, and the same thing, just a smaller scale. So the death benefit is a lot smaller when you don't put that 50,000 up front, but there are options.
So you can really choose anything you want to start with, right?
Yep, exactly. So this is just an example.
Yeah. Do you have a minimum? If you're 63, is there a minimum? Is that the minimum at 24 a year?
Over 60 years old, the minimum is about 15 times your age and a monthly premium. So 60 times 15, what is that? $900 a month would be the minimum. But then this is your own private bank. So ideally you want to put in as much as you possibly can to your own private bank, but you don't have to. There's options. So that's why I just think, a reverse mortgage is such a great deal, because your house is going to appreciate the same whether you have a mortgage on it or not. So you may as well be able to, make that money work for you instead of just sitting in the walls of your house. So
I love that expression.
Yeah, I mean, it's like the American dream, to have a paid off house. That's financial freedom, but that really isn't financial freedom, because there's many, many, many more expenses than just that mortgage payment. And then if something happens, if there's an emergency, how are you going to get that money out of the house? The only way you can get it out is by selling it, because chances are you're not going to be able to qualify for a loan. So, and with this reverse mortgage, it doesn't have to be, you don't have to wait until you need it. You can just get it, and then it's available for you. It's just a line of credit that's available for you to use whenever you need it. You don't have to use it, and then you're only going to get charged interest on the portion that you're using. So I'm curious as to what everybody else's thoughts are on, if you heard Harlan talk a couple weeks ago, what people think of what he had to say.
Well, I'll start. You know me, I always have questions.
Okay.
I can't help it. My brain just starts working. What can I say? So I'm playing with the screen. So I actually didn't know that the rules had changed. For some reason, that information never really got out there, and just had some friends lose their father's house because they were not involved when he decided to do a reverse mortgage. He gave all his money to his daughter. but he gave the house with the large debt to his son, which was just
Mhm.
real nice, wasn't it? And they had no idea what to do about it, and there was a lot of pressure paying it back. So yeah, they didn't know what they could do with it. And by the time they called me, they were already in foreclosure, which is really sad. Nor did I know you had a year to pay it off, because it used to be when you're out of the house 30 days later, you have to pay the property off. So all the rules have changed, and I think that's really helpful for people. Getting the word out is another thing altogether. And what I really like is, because I was thinking about this, you could take the money, like what you said, you could put it in something where your money will triple in 3 years, and you could actually pay, you wouldn't be ahead in one sense, in another sense you would. You could then pay that money back
Exactly.
and not owe anything if you wanted, and have that money. Now you've got free and clear money you could go play with. Or you
Yes.
could just keep investing, and set up a foundation of some sort.
Yes.
And like you said, who cares whether you owe money when you go? The kids are probably going to sell the house anyway.
Yeah. And chances are the kids don't want the house. They just want the cash. So,
Plus in
make more money
California,
on your investments and then they can have the cash instead.
yes, and in California, because of the way Congress, or whatever we call our Congress in California, put the proposition up that you could no longer inherit the property and get the step up on taxes unless you lived in the house. So that's California. And how they got that done was something about being able to change your taxes between all the different counties in California. So you kept the same tax benefit, property tax bill you have now if you bought another property in another county. There's 40 counties. So if you were paying $5,000 or $6,000 a year, and you moved to, I don't know what county wasn't on the okay to do, you would get to do that 10,000 or that $5,000, even though you were paying $1 million for a home, and not having to pay $10,000 a year. So they got that put through, and not being able to live in the house not being able to keep the house you inherit, because rich kids just use the house for partying on Airbnb, which was, I don't know who came up with that statement, but I don't know anybody that does that. They rent the house out so they get some money.
Exactly.
If they were rich, they could care less.
Right.
So that's just, again, my opinion, and I'm sorry I stuttered through that, but anyway, so that's California, but that step up is federal. It's not a California step up. So everybody else in their state will get that step up and keep their property tax where they were. But I think most other states other than New York are pretty reasonable in their taxes, property taxes. Anybody have a question or a comment regarding Harlan, or are you all too young to think about this? And do any of you have parents that you might talk to about this? Do you understand this enough to suggest that your parents think about this?
Yeah, I definitely am. I've spoken to my dad a few times since listening to Harlan's presentation, and so I definitely want to make sure I understand everything. I'll try to set up a meeting with them so they can sit down and walk through everything line by line. But going back to what you have here, Kathy, you've got you're initially putting in $50,000.
You
And
wanted to
then,
put the slide up again?
sure, you can.
Okay, let me switch to the other one. Okay,
So it started off, you had a $2,000 a month mortgage. That turns out to $24,000 a year. So now he is taking a reverse mortgage. He's putting in $50,000 into this premium.
I
Plus
mean,
the
I'm not recommending
2,000.
that he takes the money out of the house with the $50,000. I mean, he could, but that's like, I don't want to have anybody take money out of their house to put into an insurance policy. Just switching where the payment's going.
Okay. But so where did that initial 50K come from?
If he has savings somewhere else, or like, because a lot of people on this call are looking into the investments that Peggy and her team offer. So if they're already
I
thinking
see.
about investing with them, they can just add this extra step.
Okay, I see. So I've got 50K in the bank. I create this policy. I immediately put in $50,000 to front load the policy, if that's the term to be used, not sure.
Mhm.
So on day one that I open the policy, it's got $50,000 in there. Over the
Mhm.
course of the next 12 months, if I pay my mortgage into the policy, that's how I get up to $74,000 in year one, correct?
Mhm.
Okay. How soon after I fund the policy can I take a loan from the policy?
With the initial deposit, the first loan can be taken within the first 30 days.
Okay. So I fund with 50,000. Would I be able to take a loan of 50,000, or is it a 85%,
You'll probably
70%?
be able to access about 90% of that initial 50,000.
Okay.
Between 80 to 90% to be conservative. It all depends, on different factors. So, but usually, between 80 and 90% in the first 30 days.
45,000 is 90%.
Right. Well, 40,000, being 80%. So if I was trying to utilize infinite banking to capitalize on an investment that Peggy had, for example, had a $50,000 minimum. If I put my $50,000 in my insurance policy and I'm only able to get out 40 or 45, then I really need to have another $5,000 to $10,000 somewhere else so that I can combine it with the loan that I'm taking from the infinite banking policy, my own 10,000, and now I have both scenarios growing for me. I'm in the syndication for 50,000 and my infinite banking policy is growing. But otherwise, if I don't have another 10,000, let's just say to keep the numbers easy, if I don't have another 10,000 and I put my whole 50K into the infinite banking policy, then now I'm actually going to run short of the syndication. That's correct.
But you can always put more into the policy if you want, correct?
Yeah.
So if
You
want-
You
can.
can put the full 24,000 annual premium up front, so for a total of 74,000, your first deposit, and then you'll be able to access like 60,000 of that.
So you're
Right. I
only-
mean, that's
so
given if I had 24,000, right?
Mm-hmm.
As
but
opposed to just,
aren't you pulling the money out of the house? The reverse
What-
mortgage?
well, that's what I proposed at first, but then Kathy said, well, I'm not encouraging you to pull the money out of the house to start the policy. You can, but we went on this scenario of having the money from some other location. But
So
yes, if I take the
let's-
money from the house,
Let's talk about taking the money from the house. If you already got your savings and you're covered and you could cover your taxes and your utilities and your groceries, and you could take a couple $100,000 out of the house. Why can't you put all of that into a policy, overfund the policy? And if you do need any money, you can always borrow it back, right? But in the meantime, you could take, let's say 50% of that. Let's just say you took, I don't know, can you fund 400,000 into a policy, Kathy?
It depends on what the annual premium is, because the initial dump in can only be so much based on what the annual premium is in order to keep the tax advantages.
So here you're giving 50,000, but if you put 100 or 150 in, are you still in a good position? And remember, oh, this is all for if we pull money out of the house. So we could put 150 in and still be okay, correct?
Yep. Yes.
So, and our death benefit would be much higher than the 783, and we could pull the 100 or the 50,000 out to make the investment, or pull 100,000 out to make an investment.
Right, exactly. Although you're not pulling it out, you're just leveraging the cash value as collateral.
Yeah, we could borrow against our policy, our net cash value. We could borrow against our net cash value. And we still have to make our premium payments every month.
Right. Or it can be annual payments or quarterly, however you want to set it up.
Okay. Right. So if you pulled 400 out of the house and you put 200 or 150 into this, you've got all that other money, not making any money in the bank account, or you can make the payments to the premium policy.
Hey, this is David. I had a quick question with all this. In reference to pulling the money out, as you mentioned, what is the interest rate we're talking about? Let's see if it makes any sense.
Well, the interest rate that insurance company charges is like between like 4.5% to 6%, depending on the company. But you are earning interest on your total cash value, even though you're borrowing against it. They're paying you interest on the full amount as if you never touched it. So like the dividend rates are between 4% to 6%, depending on the company. So it's kind of a wash in the beginning. And then if you're paying the loan back, the balance is diminishing. So you're paying less interest, but earning more interest just within the policy, not even considering what you're earning on the money outside the policy.
Okay. So what's the best scenario? As you mentioned from the beginning, it's a wash. At what point will it not be a wash? And how would you structure it to make it to be the benefit?
Well, it would be depending on how much you owe. You can do like an amortization schedule for your loan. If you borrow $50,000, you can put it in a calculator to see what the total interest paid is going to be on that, and then what the total interest is going to be on the full $50,000 that you'll be earning uninterrupted, as if you never touched it. So it depends on the, the total loan amount plus how fast you're paying it back as to, what the difference in the interest would be. You know what I mean?
Right. All right. Thank you.
So what do you think about that, David?
I'm sorry, I had a phone call here. Yeah, I'm just trying to understand it and try to figure out utilizing the funds for other investments, obviously. So I just wanted to open up to the room and kind of a mastermind of ideas with that.
Right. So think about this. Because I had a distraction here, so I missed part of that conversation. If you have, what are you being charged? Let's say that you're being charged 6% and your account is making how much? 5?
Between 5 to 6, depending.
Okay, so you could be losing 1% or you could be breaking even. And if you are in something that's paying 11% or 30% annually, is that 1% going to make a difference? And what you need to do, and what most people don't do, is you have to look at the whole picture, not just part of it. But don't let this person in, please. This person that keeps coming in, keeps changing there.
And also, it's not actually 1% difference that you're paying because you're paying simple interest, but you're earning compounding interest. So say that you were being charged 6%, but you were only earning 4%. You would actually earn more money, even though you're only earning 4 and paying 6 over like a 5-year period.
Yeah, and you have to look at what that whole number is at the end as the benefit goes up. Kevin, you have a question or a comment?
Yeah, I have a few questions.
Good.
One is this available for persons younger than 62?
The life insurance policy is, but not a reverse mortgage.
No, but like the internet banking option.
Yes, it can be started as early as 15 days old.
Okay, and also non-US citizens.
It works in Canada, I know, but I don't know about other countries.
All right. And let's say, is there a way for you to maximize the cash value and minimize the death benefit?
Yeah, that's what we do actually, because typical whole life insurance policy, 100% of the premium is going towards death benefit. So we design the policy special to decrease that benefit. So a larger portion of the premium is just going towards high cash liquidity. And then we
Okay,
can also design it differently. So if you want more cash upfront available, we can design it a different way. We typically design it to benefit both short-term and long-term, because if you have, more cash available up front, you're not going to have as much cash building up for the future.
okay. And the last question is, say that, as you mentioned, like 15 days old, if you are to do it in a scenario where you're in your 20s, 30s, or 40s, what sort of premiums would you be paying in that event?
The premium is completely up to the individual person because it's more of a deposit into their banking system rather than a premium payment. So each person gets to choose. I mean, the minimum less than 60 is 10 times your age, generally. Over 60, it's 15 times your age. But ideally, you want to put as much as you can into the system. Like, you want to pay yourself first, like at least 10 to 25% of your income into your own private bank.
25 of your income?
25%, ideally, at least.
And so
Thank you.
people have to budget with 75% of whatever their income is.
Well, no, because remember, a lot of the money that you're putting in is available to borrow out again. So, this can actually be a way to pay off debt faster instead of just making extra payments for your debt. If you put your money in this policy and then you leverage the policy to pay off your debt, then, it doesn't really have to be like an extra 25% that you're paying. It's just making the money work better for you.
Okay, hadn't thought of that. And
Yeah,
then you
that's one
still want to
thing that
pay
we do.
yourself back.
Right. And then we have a team that works with you after you get a policy to whatever you want to do with it, like whatever your goals are. If you want to get out of debt, they will help you leverage the policy to get out of debt quicker and save a ton on interest. Or if you want to invest, they'll show you how to take the loans and what it's going to look like. And they follow up with you every 3 to 4 months to make sure you're using your policy efficiently.
Or don't have any debt.
You don't have any debt?
Live within your live within your means. No, I don't have any debt.
Well, of course, there's good debt too.
I don't
because
have
if you
debt except
borrow,
the mortgage on my house, and I guess I could make that go away.
you could make that go away very easily. Imagine how much you can make in your investments if you didn't pay that big old mortgage payment.
I know. Give me more every month.
Yep.
Yeah, I'm sorry I interrupted you. So you were going to say?
I was saying there's, you can have good debt because you borrow, at a low rate to invest. Then, the policy can help you, even get rid of that good debt. Because not all debt is bad. So I mean, it's kind of easier to make money if you actually have good debt.
Got
You're
it.
leveraging. I actually just started with the wealth coaching company that helps you stack investments on top of each other and leverage good debt to make even more money in your investments.
Yeah, super. I'll have to hear more about that. David.
Yeah, I was just going to ask, is any scenarios or some ideas that some of your clients have utilized the policies for, and what they've invested in, and kind of some of their strategies? I was just curious.
Well, I have one client who sold a house and so had, a bunch of equity to use, but had like, $35,000 in debt. So they could have just paid off the debt with that equity and been debt free. But instead, they've front loaded a life insurance policy with that money and then turned around and borrowed it out, paid off all the debt. And instead of paying the creditors all that money, they're just paying back their loan. And so they're building wealth at the same time with that money that they were already using to pay off their debt. And another one is invested in something that's paying monthly cash flow. So they're using that monthly cash flow for their premium payment. And then they built up enough cash value after that to then borrow out for another investment.
And it is that a cash flow also? So they have cash flow coming to them and they have cash flow paying for their monthly premium.
Exactly.
Right. And then as that builds, they could do it again and again and again and again.
Yep. So the same dollars are just working over and over and over again.
That's great. Harita.
Oh, yes, Becky. It's
I'm
Cassandra.
sorry. It's
Yeah.
Cassandra. My apologies. Cassandra.
Hello, can you hear me okay?
Yeah, you're a little muffled, but we could hear you.
Okay, sorry about that. I did put my question in the chat area. I just didn't know how soon you guys were going to go through those. So I was wondering about the taxable events related to this strategy. Can you give a brief overview?
Well, the cash value in the policy grows tax deferred. But as long as you access it through loans, then you never pay taxes on the money because loans are not taxable.
Okay, right. But at what point, usually, you defer your taxes or you pay them at some point. So are these basically taxes deferred until you pass away or until the policy is dissolved?
No, the taxes will never be owed. The death benefit is transferred to your heirs tax-free.
Okay, that's great. Thank you.
You're welcome.
What is taxable is if you do invest in something, we'll just say a real estate deal, whatever income you have coming in on that, you'll get your K1 on it. But when the property sells, you have a capital gains, you will owe taxes on that. But you won't owe taxes on any of your policy.
But I did learn about a way to avoid capital gains tax as well, or something different.
Good. Well,
Not
we
having
like
to
to
do
hear
it
about
all.
all those things. You want to tell us now?
Oh, it's a specialized trust, like a spendthrift complex. There's 5 different names to it, but
Oh,
it's
yeah, that one.
yeah,
Irrevocable.
yeah, exactly.
Yep. We're learning about that.
Yeah.
So Jay asked, can you describe the difference between whole life and IUL from your perspective?
Sure. IUL is based, it's tied to an index. So if the market goes up, then you're going to make more money. If the market goes down, you're not going to lose. They say that 0 is your hero with an IUL. But the problem is that cost of insurance increases every single year. So if you're not overfunding it enough, then the cost of insurance could eat away at your cash value. And I've heard way too many stories of insurance agents having to go to their clients in retirement years, expecting, to live off of their policy, only to hear that they have no more money left in their policy because the cost of insurance ate it all up. So as long as an IUL is overfunded correctly, and they have to, utilize it correctly and everything, it can be good for retirement. But as far as banking purposes go, since there's no guarantees with indexed universal life, I prefer whole life because you're guaranteed for your cash value to grow every single year. It has nothing to do with the market. It grows regardless of what's going on with the economy.
Hey, Kathy, quick question though regarding the cash value in a whole life policy versus the cash in an IUL.
Mhm.
I know that there are IULs that are increasing, so that if I have a $250,000 death benefit, my cash value may increase to 40,000 or 50,000. So now at my death, I don't just get 250,000, I get 290, or my heirs, my beneficiary gets 290 or 300,000 because of the increase in the cash value. With whole life, it seems like my cash grows, but at my death, my beneficiaries only get one or the other. They either get the cash or they get the death benefit. They don't get both.
Well, the cash value is tied into the death benefit. I'll share my screen again. If you
Right.
see,
So are there any increasing whole life policies?
yeah, see the death benefit, actually it starts out higher because we have to put in like a term insurance rider, which helps to increase the death benefit, which allows for you to dump in more cash into the policy. So in this example, it's only a 7-year term policy added on. So that's why the death benefit decreases after that. But then you see that the death benefit is increasing every single year. So as more premiums are paid, the death benefit is going up. So
Wait, can you explain that?
the cash value is just the portion of the death benefit. It's not two separate things.
Right.
The death benefit includes the cash value. So it's not like the insurance company is stealing your cash if you die, because it's built into the death benefit.
So the cash that I put in by the time I am on my 7th year keeps going up, but the benefit starts going down.
After
So-
7 years, the term rider drops off. So then your death benefit lowers because you're not paying for term insurance anymore. But then it's going to still increase.
Did my payments decrease?
After 7 years, yes, your payments do go down a little bit because you're not paying for that term insurance anymore. And then,
okay.
And then you see at year 14, it's actually goes down to 9,600.
Is there a point
you
where you
see the
don't
death
have to,
benefit? I'm sorry?
yeah, is there a point where you don't have to make payments anymore?
Yeah, anytime you want. After 7 years, if you want to stop paying at that point, you can stop. I mean, your death benefit will decrease a little bit because this is based on future payments, but anytime you have the option to stop paying. But if you stop paying at year 7, at year 8, you put in 22,000, but then you have an increase in cash value of 30,000. So it's like you wouldn't really want to stop because the more you put in, the more you're going to make.
Okay.
And then here,
So you
like
just keep using it as a savings account, basically. Is what
right.
you're saying.
Exactly. But you have the option. You can stop anytime, usually after 7 years.
After 7 years. Okay.
Mm-hmm. Sometimes even earlier.
Okay.
Yeah. So look, if you see year 11, for example, you put in an extra 22,465, but look, the death benefit increased by 34,000, way more. So that's why, the cash value it's not separate from the death benefit. It's included in there. So nobody's getting screwed.
Yeah, so this definitely seems to be a special whole life policy, different from ones that I have seen.
Yes, it is.
Okay.
Yeah, because typical whole life, you wouldn't see any cash value in the first couple of years. It would be 0. And then it would be like really, really small amounts going forward. It takes a really, really long time to build up any cash value in a typical whole life. So these policies are just very specially designed, focusing on the high cash liquidity.
Right. And I've never seen the cash value. Like if I have a $100,000 policy, whole life policy, death benefit of $100,000, my cash would never rise over 100,000. It would get up to 100,000, and then they would just give me the money.
Yeah. As your cash value can't be higher than your death benefit.
Right. And so what type of whole life policy is this that I'm using to do infinite banking with?
I mean, it's just the premium is split between what's called base premium, which is basically paying for the death benefit, and then what's called paid up addition, or PUA, which is just extra cash, which is buying like little insurance policies with that extra cash. It's just combined into one.
Yeah, so the other side is a little complicated, it sounds like. Get a bunch of policies.
Yeah, but I mean, it's all combined into one, so it's not
Sure.
like, you have to, keep track of them all. It's just each time you make an extra payment, then it just buys an extra paid up addition payment. It buys the extra insurance, but it increases your cash more, your cash available.
Okay.
And that's really what we're looking for, is having our cash available so we could go use it for something. Whereas when
That's
we're
right.
sitting in the equity in our house, which is not really doing anything.
Yeah. And another thing is that we talk about debt, but a lot of people will say, well, I don't have debt because I pay cash for everything. But even if you pay cash, you're actually paying interest still, because you're losing what that cash would have otherwise earned for you in an account or an investment. So if you save it in this policy and say you borrow out, you can still pay cash for the car, but you're paying your policy back if you want to. Ideally you do. And that way you're actually building your wealth just by buying a car. Like with just that first car, you're going to recapture over 90% of the money that you paid for that car by using a policy. And the second car, you're at almost 100%. So you have the cars and you have all your money back available to use again.
Yeah, that's the best part. Why did they teach us this when we were young? All you people that are young, which is all of you on this call, listen up. Think about this. This is serious money for you to make to build your legacy. It's not that expensive to do. Everyone really ought to be having a conversation with Kathy about this, or if you have somebody you're already working with, have that conversation, get something started. It doesn't matter whether it's a little bit or a lot. You're not 15 days old anymore. You're all over 21. Your parents didn't start this for you. They never had the conversation with you. So start moving. Really, this is incredible. You get to keep your money. If you think about it, you get to keep your money. It's just stored in a different savings account. And if you're paying yourself your 10% out of each of your investments, or if you have a regular job, your paychecks or whatever, and you're putting it in this, you have it available to take back and put it somewhere else and make money. That's how you grow exponentially in a faster way. That's my 5 cents on it. It used to be 2 cents, but with inflation, had to go. Thank you for somebody getting that today, Fidel.
Yeah. And the thing is too, like, don't think like you don't have enough money, you want to have a bigger policy, so you're going to wait, because it's better to start small than not at all. So you can always add extra policies as time goes on. Like one of my mentors has like 20 different policies. So just as your income increases, you just add another policy. You can only be so big based on your income. So you make more money, then you get more policies.
Right. So you just have to start more policies. So if you started with let's say you were paying $50 a month policy, if you then were able to pay more and you could finally like get up to the 2,000, you'd have to start a new policy. You couldn't add to the one you have.
Right, because once you decide your maximum premium payment, then
Ah.
you can't add more. Like, but it is flexible. Like if you say you want to put $1,000 a month, but some months you only have like 400, you can, it's flexible between 400 and 1,000. So you
Oh.
don't have to pay the full 1,000. And then, you know, if a couple more months down the line you have extra money, then you can make up for the premiums that you didn't pay.
Wow. So especially designed just for you. That's why you need to have a conversation. You need to talk to the right person about the policies. I hear this every morning on KNX radio when I'm listening to the news part of some guy put you into a term policy for $1 million. And I don't know that term is where you want to be unless you have it set up where it's convertible. And they never say that you could do anything else with that policy, which is too bad.
Yeah,
Because a lot of times, isn't this so? Once you go into a term, it's not convertible. So you have to talk to the right people.
right. Yeah, term insurance is the biggest moneymaker for the insurance companies because it only pays out less than 2% of the time. So people either cancel it or outlive it. So the big objection to whole life is just buy term and invest the difference. But because you're going to be able to self-insure because you're going to make so much money with your investments. But with whole life, you can have the insurance for your whole life and leverage that money for your investments also. So it's not a choice of paying extra money and not having it for investments. So you get both.
Right. And term goes away. That's why it's called term, right? So
Exactly.
I consider that stealing, frankly.
Yeah. I mean, some people just have absolutely no choice. They just have no extra money at all, but they want their family to be protected. You know, so there is a time and a place for term insurance, but just know that
there's
chances
term
are-
that could be converted, right? Some term can be converted.
Mhm.
And
Yes.
there are other kinds of policies too, I presume, between term and whole life.
there are all kinds of different options. But
Yes,
whole life is the one with guarantees. Your money's going to guarantee, it's contractually guaranteed to increase in value every single year, and you will be covered for your entire life as long as the policy stays in force. Even if you decide to stop paying on it and called it what's called reduced paid up.
What's it called?
Reduced paid up, when you stop making your premium payments. But then you still have
Policy still stays in existence.
Yep, it can. Mhm.
And maybe it will grow. Or maybe it won't grow. Is that possible? that it
The
wouldn't
cash
grow?
value will still increase in value.
It will
even when you're not-
because it's even
because-
though you're not making payments, whatever you were at that time you stopped making payments, it just grows for the cash value.
Yeah, because you still have the guaranteed interest rate plus dividends on top of that.
And do you make sure that that is put into the policy when you set someone up?
Yes, there are options that you can take the dividends as cash, but we like to choose to put it in as like additional paid up insurance. So your money will grow even more.
Yep, it's good. Any questions, any comments from anyone else? Vinky, you teach people all about money. Do you have any comments about this? I like to put people on the spot. Isn't that nice? If she's even there. She has her own show. She teaches people about raising funds and investing and growing and growing and growing with real estate. So we like our Angel's not here. She does the same thing. Ethan is here and he does the same thing. Yes, Ethan.
I have a question, Kathy. Sorry if I missed it earlier. I came in and out to watch the presentation. But do you ever have clients that pledge their policies to banks? And are there any specific banks that you recommend? I've been with Investors Bank for a long time, but they recently sold to a completely new bank, and it's been a bit of a struggle to actually get the account serviced properly.
You mean using it as collateral for a bank loan? Is that?
Yeah. So that's what I do. So that's it's cheaper than borrowing from the life insurance company, generally speaking.
See, I don't have clients like that.
Okay.
I try to get, my whole goal is to get away from the banking system, even if the bank is going to charge a little bit less interest. I prefer to have control. So if I borrow from the bank, I'm going to have a set payment to that bank. But if I borrow from my policy, although my interest might be a little bit higher, I get to have control and set the terms on the loan repay back.
Do you get to do that when you're working with the bank, Ethan?
I think it's actually more control because I can just pay it up and down as I want. It's a revolving line of credit. So I prefer that versus borrowing all or nothing from the insurance company.
Oh, you have a revolving line of credit with the insurance company as well. You can pay back as much or as little as you want.
Oh, okay. I guess it just depends on the specific company.
All the
Oh,
companies
probably
that I
both.
work with, you're the bank basically, so you make the terms. If you want to pay yourself $100 a month, $1,000 a month, or none at all, it's completely up to you.
But you have to have that cash to borrow from. He's talking
Yes.
about a line of credit. So the line of credit could be $1 million line of credit, and he could borrow anything he wants against that line of credit.
Oh, so you're using the whole death benefit as collateral, not just the cash value?
No, they only lend on cash value. They don't lend on debt.
Okay. So
But
what kind of interest rates are they charging?
So it's prime minus 1.25 because I have over 2 million of cash value. So my line is really large. But what I liked about it was it's just like a home equity line of credit. I can pay it up, pay it down, draw it whenever I want instead of having it with the insurance company because usually they don't wire funds, so they might be slower.
Yeah, with the insurance company, it generally takes about 3 days to get the money transferred to your bank account.
So you don't have the ability to just write a check
No, you
Yeah.
have to.
or transfer
have
the
them
money from
transfer
that
it to you.
account. So you can't transfer your own money out of that account into your own bank account.
From the insurance company?
Yeah.
Yeah, when you want the money, you just tell the insurance company you want the money and then they will transfer it to your bank account,
Okay.
usually within 3 days. And then there's no need to qualify for a loan or anything like that. They don't ask you any questions. You just say you want the money and it's done.
Yeah, and they verify it's in the account, I'm presuming.
Yes, they're not going to loan you more than your available cash value.
But you could do this for all your kids. You know, you said you wanted them all to be millionaires by the time they were 30, Ethan. They could do it with this, and you could be their trustee and direct all the money and build that up into that millions of
Oh,
dollars.
my kids already have policies, Peggy.
Oh, of course they do.
I mean, I'm also an agent, so I mean, I write the policies for my own stuff, so it's easy.
Of course, Ethan. I don't know why I even thought that wouldn't happen.
I'm
I
like
work with companies
I-
that design policies this way to decrease the death benefit, to increase liquidity.
I didn't make it to the first part of this, but in general, are you doing like just additional paid up stuff or like additional life insurance into the policy day one or something? Is that what you're doing?
Yeah, we do paid up addition. So we split the premium between the base and extra cash. And then my favorite way is to have a dump in so people can just, make that money work harder for them, put it in and then borrow it out.
Yeah, we've definitely done that. And I own a couple of policies myself that are like that. But in general, we've been moving away from that. And we actually just usually do the ones that are just straight up higher cash value instead, because then the chassis is already built to maximize the cash value up front instead of having to game the system. Because usually even gaming the system is not doesn't get you as much cash value as just taking advantage of one of the chassis that already is built for high cash value.
Chassis? Like
Yes,
on a
we
car?
talk about policies like cars. So we talk about the design as a chassis.
Okay.
Just industry speak.
Yeah, the industry. Okay, good. Does anyone have any other questions before because we are at the top of the hour. Kathy, thank you so very, very much for coming on. I am
Welcome.
really, really excited about all the things that could be done. And here's Cliff clapping his hands. He's giving you a standing ovation, which they would put that under. So thank you very much for coming.
Thank you for having me.
Hope you will come again soon.